Welcome to OpalesqueTV. Today I'm in Tokyo together with Ed Rogers. Ed is the founder of Rogers Investment Advisory. I know Ed for a long time, and in fact out of the 27 years, the last 27 years, 20 he lived in Japan. Now Ed, please tell me your story. How did you get started here in Japan?
I came to Japan originally in 1987 on a Princeton in Asia fellowship to live in Japan for 1 year and work at a Japanese steel company. Now, Japan in 1987 is very different from Japan in 2014. It's easy to say actually that the rising tide of Japan was lifting all boats at that stage, and I received multiple job offers to go work in the financial services industry, where I had absolutely no background. But it was a very cutting-edge, exciting time to be in financial services in Japan. So I very quickly fell into foreign exchange trading, and I had an 8-year career in trading currency forwards, working in both Tokyo and for 4 years I lived in Hong Kong as well. Then I went back to the States for 2 years, went to business school, went to Georgetown to get an MBA. From there I went to London for 2 years, and I worked on a proprietary trading desk at Merrill Lynch in London. And then I came back to Japan in 2001, where I have been now for the last 13 years in Japan. I spent 5 years working at Deutsche Bank from 2001 through 2005, helping them to build out their hedge fund businesses in Japan and throughout Asia, but primarily in Japan. My responsibilities there included helping what I would call the Tier 1 client base for Deutsche Bank Prime Services. So these would be hedge funds that had 5, 10, even 20 or $50 billion worth of assets, of which they would deploy a significant amount into the Asian space. The other responsibility I had at Deutsche Bank was helping assist with the startup and launch of new managers. Back in 2000, there were fewer than 100 hedge funds in Asia. It wasn't an industry. It was 25 guys drinking in a bar on Friday afternoon in Lang Kwai Fung or in Roppongi. From 2000 through 2007, the industry, the Asian domestic industry, grew to almost 1,000 managers. And I had a front row seat. I was a participant, frankly. I wasn't even a front row seat. I was in the ring, if you will, working with hedge fund managers as they were getting started and working with lots of investors. The Asian story has really been an incredible story of growth, outside of Japan, that is. China, India, the whole BRICS thesis has been one that really captured the imagination of investors worldwide, and it captured the wallets of investors worldwide as they tried to figure out how to participate in this story. Over the same time period, Japan has been not just the sick man of Asia, it's been the sick man of the world. It's been the economy that couldn't, if you will. And I had numerous experiences, hundreds of meetings with investors who were based overseas, based in the United States, based in Switzerland, based in London. And I got to really know what their concerns were about the Asian hedge fund businesses and their problems with allocating to Asian hedge fund managers. And to sort of sum up what I learned from, let's call it from 2000 to 2005 about the Asian hedge fund space and how investors view it, I'd say that Asia is too far, too foreign, and too small. Too far is pretty simple. If you're based in New York or London or Geneva, Zurich, Boston, or Chicago, you have to get on a plane and spend 15 to 20 hours just getting here to view the opportunity, to meet the managers. Once you get to Asia, too foreign is what we call linguistic and cultural barriers to entry. So in Japan, for example, where we have a Japan-only hedge funds product, 40% of our managers don't really speak English. You have to speak Japanese to communicate with these managers. I would say in North Asia, so China, South Korea, Japan, you have a similar problem where many of the managers and certainly many of the support staff to the business will speak Mandarin or Cantonese or Japanese, but they will not necessarily speak English. This is a huge impediment to understanding the opportunity set. If you literally don't speak the language where you're trying to conduct due diligence, you find yourself, well, as we found quite often, many investors simply walking away from the opportunity because they couldn't understand it. It wasn't in the right language for them to understand it. So Asia is too far for many of these investors. It's too foreign, and therefore it's too small. I left Deutsche Bank at the end of 2005, beginning of 2006, because I thought I could add value by building my own business that solved those three problems that many investors have. Asia's too far, Asia's too foreign, and therefore Asia's too small in their portfolios. The beginning of the business, our first product, was launched in November of 2006. And I sought to take full advantage of my lifetime of adult experiences in Japan by launching a Japan-only product that was very focused on generating alpha returns for our investors. I'm very pleased to say that after 8 years, we've generated almost 40% alpha for our investors in that product. It is a true Japan-only fund. Portfolio look-through basis, that fund is about 80% Japanese equities, 10 to 15% Japanese credit products, credit and convertibles, and another 0 to 5% futures and foreign exchange products. But it is truly a Japan product, and in that fund, our day one investors, so our launch was November 1, 2006, so well before the crisis of 2007 and 2008. Our day one investors have only had one negative year, and that was in 2011. In 2008, when most of the rest of the world was down 35 to 45%, our investors had net returns of greater than 5.5%. We're very proud of that. So we took what is our basic stock in trade. What do we do well? What's our value add? Asia's not too far for us. Asia's not too foreign for us. We have offices here in Tokyo. We have offices in Hong Kong. We have native Japanese speakers, native Cantonese speakers, native Mandarin speakers on staff. What is it that's easy and basically very inexpensive for us to do that might be hard and expensive for somebody else to do? And the very easy answer to this question is we conduct hundreds of on-site due diligence meetings with managers in Asia every year. What makes us very different from many of our competitors who are based overseas, and possibly many of our competitors who are based in Asia as well, is the sheer number of due diligence meetings we do, and I'd say the level of staff that we bring to those meetings, the level of experience that our staff members have who attend these meetings. I have a team of people that are every month doing due diligence meetings, boots on the ground in Asia, in Hong Kong, in Singapore, in Tokyo, and we have an enormous cost advantage when we do this. We do local due diligence meetings in the language of the manager, and we all in have a cost per meeting of less than $200 per meeting. We meet many managers before they've even launched their business. The prime brokers, the service providers, the lawyers, the accountants, the fund administrators constantly refer new managers to us even before they've launched. And what that means is we can spend enough time getting comfort and confidence that we know the manager, know the strategy, and know the level of business risk involved, that we can invest in managers who are managing 10 or million or $15 million, $20 million, tiny amounts of money by global standards. Yet we find some of these managers are incredibly productive. When they're this small, they're desperate to gather assets. And since we're willing to be an early investor at those smaller levels, we can quite often get concessions from the managers as far as management fees and performance fees. We've been invested in sub-managers with sub $20 million of assets under management where we pay zero management fee. We've received significant concessions on performance fees as well. Our Pan-Asian Growth Fund. It's going to be specifically targeting growth, high growth, double-digit growth areas of the Asian world and strategies that are built to take advantage of that. Now, we also have some bells and whistles on that will help make this a very, very, very interesting investment for high net worth and family office investors who can put in a minimum of $10 million on day one to be in a founder share class where they receive significantly reduced fees and they have access to significantly more of our research. In the response to the global financial crisis and Madoff, many times we hear investors complaining about fees. We hear investors saying, why can't I just go through an ETF to get exposure? We hear doubt and we hear distrust in many of our meetings. Well, we think that global investors need to understand that hedge funds and the alternative investment world in Asia is exactly the place where you want to take risk. It is exactly the place where if you can get yourself into top quartile performing managers, you will dramatically outpace the returns associated with, for example, an ETF. So one of my investors, I have a Japan-only fund of funds product, and we've quite often had conversations with investors about DXJ, one of the largest Japanese ETF products. And I went back to look. So if you had invested back in November 1, 2006 in the DXJ, you would have bought in at, I think it's $52.33 a share. As of just this last week, after a 5% upraise on a Friday close, where the Japan Pension Fund and the Bank of Japan have clearly planted the flag on support of inflationary measures, that ETF would be up a total of 3.3% after 8 years. Our day one investors in our Japan-only fund of funds are up close to 40% over that time period. So I'm often asked, what is the biggest danger an investor needs to be aware of when they're putting money into Asian markets or they're putting money into Asian alternatives? I think the biggest danger, historically speaking, is that if you're based in New York or London or Geneva or Zurich, you're always asleep whenever the problem happens. Literally, you're on the other side of the world, 14, 15, or 16 time zones away. So to truly be successful in these markets, you need to be nimble. You need to be quick. When you hear that oncoming train that's going to flatten you in your portfolio, you need to be able to jump off the tracks really fast. And in our experience, it's almost impossible to be good at that if you're not physically based here in Asia. So unless you have the resources to open up an office in Hong Kong or open up an office in Tokyo, as we have, you need to find someone you can trust with that decision, which means you're outsourcing a risk decision. When do I de-risk? When do I need to get out of the way of the oncoming train? How nimble can I be versus how nimble can my agent on the ground in Asia be as far as responding to problems? Of course, the next part of this is we don't believe that just being a long-only investor is the right way to face Asia. You don't have enough tools in your toolkit to respond to crises and to take advantage of them. We like hedge fund managers because they can go short as well as long. And short can sometimes be used as a hedge. Again, we're just worried that a problem might arise. Shorts can also be used to generate returns. When you're pretty sure something is overbought, or you're pretty sure that people are too excited about a particular market or a particular sector in Asia. Good example of this would be, there was a Japanese Nobel Prize winner, and the small mid-cap pharmaceutical space in Japan all of a sudden had a huge uptick as retail investors got very enthusiastic about an area where a Japanese individual, a doctor, had received a Nobel Prize. The hedge fund managers almost uniformly saw this as short-term irrational exuberance. You're not going to get 50 different companies that all of a sudden produce a Nobel Prize winner. Great shorting opportunity. Great way for our investors to make money off of a short-term distortion in the markets. But you had to be physically present, you had to understand why this was happening, and you had to have that tool of being able to be a short seller to take full advantage of this. So hedge funds offer more and more throughout Asia, we believe, the best toolkit for managing risk day in and day out. And you need to understand, risk needs to be managed, it's not even daily anymore, hourly and minutely. Risk needs to be managed.